So finally we are out with our new templates, new edition of Blockrevision with some new features that I hope you find interesting. Sorry for today's delay, but we were fixing some issues that the template brought. So today, as every time, about stock market, indexes, commodities, cryptos, but in a little bit nutshell, as we are performing a little bit later, as our office closing down soon in Europe. So I need to shorten today's episode for a while. Okay. So let's get into the point, and at first let's have a look at what we have right now. So Fed united on need for higher rates. Hiking still reasonable. Do Fed? So President Mary Daly said hiking rates by 50 or 75 basis points are the most probable and the most reasonable at the next meeting of Fed. So their goal is to achieve a 3% inflation, and every single level out of it will be out of the mark. So will we get it by the end of the year? That's very hard question. I do find Fed will still hike interest rates even further throughout 2023. However, Fed don't want to have hiccups. That's why they don't want to make an abrupt changes in their policy. As there's as a business or a consumer, there's nothing worse than when the changes are coming rapidly, whether it's up or down, because it causes lots of caution, lots of uncertainty, and lots of instability for the whole system. That's why they are moving slowly, but in my opinion, they have reacted too late for this. Whether even if they considered hiking interest rates, they should move it more quickly. Can we bring inflation down without triggering a recession? That's the question that every analyst pose to himself, and not have an obvious answer. How this recession or this problematic scenario we are right now at, however call it, may eventually look, will inform you up to date. So at first I just wanted to mention where we are at the thematic right now. It's a economy view. I've switched 2 slides instead of 1. So we are jumping to slide number 3, and EU economy is hit by storm. So that's the problems we are right now facing as a EU, the problems coinciding right now, and that's the major issue. So prospects for easy 2023 are diminishing as energy costs moved to another sectors of economy. This one, the one that suffers, is trade balance that from surplus went into deficit. So it's hard not to crack for all euro area of how eventually it may come, and as EU inflation is also off the chart due to mainly energy problems. So returning to US, evolution of Atlanta Fed GDP, now real GDP estimate for 2022 for quarter 3 has made a pivot. So Atlanta Fed expecting that we will contracting after positive projections back in the beginning of August. It looks like someone is playing with with price action, I would claim. I would hazard to guess that Fed might be manipulating courses of different assets by revealing those measures of projections in that fastly changing manner. So right now we are expecting this one to contract to even below 2% level. In terms of leading economic index, we can find that this 6-month annual rate of change is highly correlated with S&P 500 earnings growth, and with this one just dropping further, we may have earnings dropping as well. So it's not a positivity right here. US mortgage, in terms of US mortgage, we may find that payments as percentage of income higher than at the top of the subprime bubble, it brings us to a conclusion that it will be very hard to get out of this different scenario we have placed in. However, as a conceal, there are just typical mortgage payments for a median family income buying a median priced existing home at current mortgage rate. So the actual mortgage debt service is of a little bit lower level than in regard to disposable income. That's why we may find that there are some chances to get off this without a severe crash. All right, so we are right now getting to residential mortgage applications from mortgage bankers, and this one, mortgage rates are dropping to the uncharted levels and where haven't been seen even back in early 2019. However, US mortgage applications, mortgage rates are rising. However, US mortgage applications index are dropping. So that's the revert relation. Right, so right now let's jump to market outlook, and as always, starting up with trading view. Let's have a look at this one. All right, so on SPX we are right now reverting the course right after hitting this ceiling on 3300s. On SPX, right after there is high possibility we will rebound out of 4200s. So correction from this level is very possible, as earnings and margins recently deteriorated going into 2023, and also this GDP projections has also became worse than expected. So right now we can find that that was SPX, and in terms of US 100 the drop is even more severe at minus 1.93% at today's session. Right, so it looks like we are trying to retest this trend line that may bring back prices at the levels at 13,000s. All right, so going as of next, and there will be a kind of interesting analog in which we find that in 2008 we have just marked the top at this dead cat bounce before a severe rally downwards. Right now we are forming a similar pattern with not maybe this similarity, not hitting 100%, but have its common points. So right now, even with this taken that circumstances are a little bit different than previously, we may find that this time in 2008 there was a more severe outcome of the situation than it's right now, and it may point that with this price reaction we may get closer, but this rising wedge is not as strong as it was back then, as we have started another impulse forward that may not be repeated to the 2000, may not be repeated as it was back in 2008. So tech and industrials recently were the biggest losers, right now becoming biggest winners. That's often on the market where the stocks, the equities are of strong fundamentals and are hitting by sentiment and bad earnings in some cases. They may rebound right after hitting a significant price levels, and that's happening right now. FEMS says growth is about to outperform value for the first time since August 2020. Right, as of next, let's have a look at seasonality that still is handing out cards, and end of summer is most often positive, but September most often brings a correction. As a conceal, I would find that on September the capital is started flowing back into the markets, and that's why there is more of an expectance that last 3 quarters of 2022 may bring better results. Right, so right now let's get into I'm trying to restore the slides. All right. In short horizon, we have expiration of $2 trillion today, and that's one of the opportunity why those forces on the market may change. Usually, it happens right after important contracts expiration. We have of different indexes those expire, and that's why there is a chance of switch market forces. Those contracts that recently played for growth right now might be playing in the reverse. Volatility may pick up soon with September upcome. Right now, let's jump to crypto outlook, and here we have a kind of a redo where cash has gone. So recently we've seen more than $200 billion erased from entire crypto market in a day. That happened back in May, but right now we are trying to recover, but something that hasn't been marked on the chart was the bearish candle that started right after 15th of August. That's the projection by half of August this year, and with this one, the projection, we may find that in terms of Bitcoiners that are holding the tokens, those that held less than 3 months right now are outpacing those that are holding for another periods of time, and that's how we can find that the sentiment around the market right now is rather dragging more short-termers than long. So that's the very interesting conclusion in terms of what may revert the sentiment on the market is this major change in Ethereum mechanism consensus being delivered. So you may find how the process is going on when merge.com, and event is expected to take place on 15th of September. In terms of market movers, let's jump to economic calendar, and right here we have a we already went through. On Wednesday we have had a GDP growth rate out of EU, European Euro area, and that one has contracted due to previous episodes. We had FOMC minutes in which we have heard that the consideration of 75 basis points rate hike will be already intact this month. In terms of inflation rate of euro area, I've just mentioned that's the highest since 90s, and initial jobless claims of US right now has dropped for a little, but still remaining at the levels that are still putting in favor Fed to further hike. So in terms of those aspects, these are the most important. We still have today Fed Barkin speech at 9 a.m. New York's time, and that will maybe not worthy to listen. In terms of let's have a look at earnings season. This one on Thursday been very favoring for Canadian Solar, so it's really pushing further this TAN ETF, and we also may find that Applied Materials was also with a tiny surprise, but market has priced it in as a more bearish than it supposed to be. Today we have still not many important earnings, but still Macrobank and campaign financier Richmond. Today I don't have for you trade idea, as I mentioned we need to end up a little bit earlier, but I invite you for the new episode on Monday that will be of many interesting news. Thank you very much, and